the investing side, I'm an agent. I've been an agent for about 7 years, local here to the Bay Area, helped over 60 buyers and sellers in the last few years. One of the things that we are really excited about is helping new home buyers, first-time home buyers, because it's just fun to see people get into their houses and be excited about the process. So here, in a nutshell, is just kind of a few things that we're going to hit today. Here are the 8 simple steps to home ownership. A little bit involved as we get along, but if you want to write them down, here they are. 1, we're going to go over the idea of deciding to buy. 2, the importance of hiring an agent. 3, the importance of securing the right kind of financing. The fun part, finding a home. 5, making an offer. 6, once we get into contract, performing due diligence. And then 7, the close. And then finally 8, protecting your investment. So let's just dive in here on deciding to buy. One of the important reasons to buy a home, as we see here from this slide, is that we see that renters on average have a net worth of about $4,000 versus someone who owns a home has an average net worth of about $184,400. And yes, that is tied up in equity, but when you get ready to retire and sell your house, that $184,000 comes in pretty handy. Your home is your largest investment, and most people do have equity and appreciation over time. As we see here, an average annual appreciation rate nationally is 4 to 6% since 1977. We have an example here at 3%, an annual percentage rate for a $450,000 home, which is kind of average here in the East Bay of the San Francisco Bay Area. We're going to see over 30 years that house, if we have what we've had since 1977, your house is going to be worth about $1 million, a little over $1 million in 30 years. Even if you cut that in half to 1.5%, you still see your investment of $450,000 over 30 years grow to be just a little bit over $700,000. Buying your first home, of course, is an emotional decision. Home is where your heart is at. Most homes are represented by personal taste and provide a haven and stability for security for both you and your loved ones. Provides a pride of home ownership because it's yours. I can't tell you how many houses Devin and I have been in and out of over the last few years, but it's been a lot, and every house is different. And what you'll see is people love their homes, and that's what we want for you too as a first-time home buyer. It's also a rational decision. Home is where your wealth is. As we illustrated a couple of slides back, over 30 years, you do grow a little bit of a nest egg. That can change depending on where you live and what the market does. But on average, as we saw, 3% on a $450,000 home does add up. So you can grow wealth via your equity buildup, debt pay down, and even value appreciation. And then in the United States, you can take advantage of tax deduction benefits that are geared towards property ownership. That includes write-offs and just being able to itemize taxes. Continued here, home is an investment that creates leverage over time. In a few years, you can use your equity to trade up to a better home, or you might consider using some of your home equity to invest in a rental property. That passive income is always a great thing to have during retirement time. The question that you got to ask yourself is, why pay rent when you can own? Here we see a 30-year fixed at $150,000 and a monthly payment of $900. That is a little low for our area, but it's just kind of a ballpark number to tell you what things are going for versus what you're going to pay for a loan. You'd expect to pay $324,000 in mortgage and interest over a period of time on a $150,000 home, and after 30 years, you would own that home with you wouldn't have to make any payments other than your property tax. Keep in mind that appreciation rates vary greatly based on the location and conditions of the property. Compare that to paying $800 a month in rent over 30 years. Even if your landlord doesn't ever raise your rent, which is not likely, you will spend $288,000 and own nothing. Hiring your agent. This is the tricky part. Real estate agents perform 7 main roles. 1, they educate you on the market. 2, they analyze your wants and your needs. 3, they steer you to a home that fits your criteria. 4, coordinate and work with other needed professionals. 5, negotiate on your behalf. 6, review paperwork and deadlines. And 7, solve any problems that may arise. On the surface, this may look easy, but it does take a lot, and you need to have trust in your agent. Advantages of a buyer's representation agreement sets mutual expectations in writing between you and your agent, commits you and your agent to one another in getting the home you want while you commit to working exclusively with your agent. 6 steps to financing a home. Financing is incredibly important, and Devin and I like to work with people we know, trust, and have performed over time. So we have many great people that we can refer you to, but just 6 steps to financing a home here. Choose a loan officer or a mortgage specialist that you can know and trust that can get the job done. Make a loan application and get it pre-approved. Determine what you want to pay and select a loan option. 4, submit to the lender the acceptable purchase offer contract. 5, get an appraisal and title commitment. And 6, obtain funding and close. What you need to know are your mortgage options. The 3 main factors that will come into your options, be it an FHA loan, a conventional loan, an all-cash loan, or all-cash offer, are 3 basic factors. 1, what kind of a down payment do you have? You need to think about the interest rate and your term. Understanding your monthly payment. In your monthly payment, you're going to have a couple of different things involved. You're going to have your principal, what is owed on the house, the interest, the amount you pay for having the loan, then your taxes, that's what the state will charge you, insurance to protect your investment, and depending on how much you put down, you will have PMI or what we call title insurance. Together, all of these elements are commonly referred to as PITI. Pre-qualification versus pre-approval versus advanced approval. Pre-qualification is simply a rough estimate at how much you can borrow based on the numbers that you provide your loan agent. A pre-approval involves a formal application process and provides you with a formal commitment for a lender stating how much you can borrow and at what rate. Deciding among your mortgage options. If you want a low monthly payment, put more money down and purchase a more affordable home. A low down payment can be worked like this. You can secure a second mortgage, what we call an 80-10-10. So you put down 10%, you have a second that will give you 10%, which will equal 80%, which will help you avoid any kind of PMI payment. To build equity quickly, you should make voluntary payments, meaning you make extra payments along the line. If you make one extra payment starting at the beginning, it will reduce your 30-year mortgage down to roughly 23 years. To minimize risk, take a 30-year rate and put 20% down. The lowest down payment you can put for an FHA loan is about 3 to 3.5%. The suitcase principle. Your lender decides what you can borrow, but you decide what you can afford. They don't always match. Your lender is pretty much going to tell you your max, and you need to be comfortable with what you decide. In your pre-approval letter, make sure that the monthly payment is the amount you are comfortable paying each month. It is best to spend no more than a third of your gross income on your home mortgage payment. Here are a few examples. At $500,000, if you put 10% down, roughly $50,000, your principal and interest, tax and insurance, and this also includes PMI, will be roughly $3,200. Your closing costs will be around $15,000. Your income requirement, roughly $100,000. And that can be combined with you and whoever you may be buying with. If you want to do a $500,000 example on an FHA loan, 3.5% down is roughly $17,500. Your principal and interest will be, with tax and insurance and PMI, will be right around $3,500. Your closing costs will be a little bit higher because there's a couple of fees associated with FHA, but you're around $16,000. And again, the requirements for income are about the same at $100,000. So finding your home. You need to define your home criteria. Basically, you need to understand what you want and where you want it to be. You need to go through and understand what is important to you and not important to you, and then also narrow down your wants and your needs at the same time. You'll see a lot of homes, and some will meet your criteria perfectly, and others may not. You need to also consult with your agent so everybody can be on the same page of understanding the rules of your market. When viewing a home, what you consider and what your agent considers might be different. You'll want to look for these things: a layout, space that you can see your family in, a sense of value, convenient location to work and school, and features and amenities that are important to you. Your agent, on the other hand, will be looking for something different. They will be looking at how the home compares in terms and size, the layout and the value to the other homes in the area, as well as the maintenance and the structural concerns. One important tool that we often get asked about is Trulia and Zillow. Oftentimes, you will see homes on Trulia and Zillow that are no longer for sale. So it's important to use the right kind of tools in your home search. Trulia and Zillow can help you with broad line terms, but it's probably easier and better if you use an app. We have a great app that you'll have access to at the end of this webinar. But just know that Zillow and Trulia are not always up to date. Here you go. Here's that place where you can download that app. It's always up to date. It updates itself. It also gets, this data comes directly from the Board of Realtors, so that's how it keeps more up to date. There you can see the address, and go ahead and download that. You'll love it. Making an offer. Here are the components of making an offer. Price. Offer price must reflect the true value of the home. The terms, the 6 basic categories, addressing timing and financial considerations. And then lastly, contingencies, often referred to as conditions that allow you to opt out of the deal if the home has a problem or you get cold feet. So making an offer. We're often asked, what is a fair price? Well, that depends on a lot of stuff. How long has a home been on the market? If it's been on the market for quite some time, you might have some more leniency on the offer price. Are there any other offers on the property? A home that has 0 offers versus a home that has 27 offers, you're going to have a much different idea of what is a fair price. What are the surrounding houses being sold for? If the surrounding houses are being sold for $450,000 and this house is listed at $299,000, probably a fair price is going to be around the $450,000 mark. Is the property a distressed sale? Is there something going on behind the scenes? And to that last one there, is it priced correctly? As we talked about just a second ago, if it's marked far under what the houses in the neighborhood are going for, don't get too excited, because the chances are there's going to be a lot of offers on that house, and it will go for what the market value is at. And what is market value? It's pretty much what the market will bear. If there's someone willing to pay $475 for a house that's listed at $299,000, $475 is the market value of that home. After you get into contract, you need to perform your due diligence. That is in the form of property inspections. These inspections expose any kind of structural or hidden issues. We often say that you should start out with the 4 main ones. That's going to be appraisal, home inspection, pest inspection, and a roof inspection. And typically from there, you can get a good sense if you need to do any other kind of inspection. A homeowner insurance policy protects against your loss or damage, so that's also important to have during that time. In your inspection, it's the big stuff that really matters. A couple bugs here or there, unless they're really, really bad, aren't a big deal, unless it's a big deal to you. But for the most part, the things you want to look out for are cracks or crumbling foundation, cracks inside the house over the windows, large cracks that is, water stains in the ceiling, floor, or walls. If you have water stains in the ceiling, you might have a roof problem. You want to look at that roof. Is there any fading or worn shingles? And a big one is, are there any signs of a mold issue? If there are, you can get a mold test. Now we're down to the close. This is something that everybody loves because you have gone through the hard part of getting pre-qualified. You've gone through the part of looking at homes and making offers, and you finally got accepted. You've gone through your contingencies where you've done your inspections and your appraisal has come back. Everything looks good. And now we're going to move to the close. So pre-closing responsibility include, as we talked about, appraisal, survey, title search, and a title insurance search to make sure that the property can get title or insurance. Keeping your mortgage worthy, just making sure that the house is worthwhile, and doing a final walkthrough of the home. So. We have a question here that says, what is the difference between buying a house versus a condo or a townhome? So the main difference there you're going to get is a home, a single-family home. More people are going to be looking for those because they don't have HOA fees typically, and you get a little bit more freedom. With a condo or a townhome, they're pretty much, condos and townhomes are very similar. They just might be built a different way. One might be a high-rise where a townhome might be 2 homes connected by a common wall. What you get in those is you're going to have HOA restrictions, so you're not going to be able to do certain things. And the big one for me on those is the HOAs, because you can't keep HOAs at a certain price. You don't have any control of that. That's up to the board of that HOA. And if they decide that they want to raise your HOAs $100 a month, they can do that. Typically, you're going to also have less of a yard on a HOA or on a condo or a townhome. Typically, you'll have some parking restraints as well. The good thing about them is that if you don't want a yard or you don't want the maintenance of keeping up outside, you can have that. A lot of times they have a pool or a gym or something like that that could really help you out. So it really depends on what you're looking for. Hope that answers that question there.
Cheaper for condos?
And condos are a little bit cheaper, but you got to watch the bottom line there, because depending on what the HOAs are, you can really, it might make the payment the same. All right, so we'll get back to this idea of closing. The countdown to the close. What that includes is getting your settlement. Tells you what your final down payment is going to be, including closing costs. So you're going to get certified funds to give to title, and then also you're going to give title evidence of insurance, and then title and escrow will transfer you clear title. Two things that you can do to protect your investment. Just what you need to do is keep it clean. A clean house is often a house that doesn't have many issues. You can also do routine inspections. I always encourage my buyers to do a pest inspection every 2 to 3 years, just to make sure that you don't have any issues. Same thing, you can get free roof inspections and stuff like that from roofers. Just want to keep an eye on stuff, make sure that it's all, things are progressing as they should, that you don't have any big leaks. If you see anything, like if you see any cracking on your foundation, you might want to get that looked at. Just make sure, keep up on your paint. And this might not be a fun thing for some people, but if you don't smoke in your house, it really extends the life of it as well, your paint and everything else. So what next? To get started, you need to get a pre-approval going from a lender. We can help you with that. If you want to just be looking at stuff, trying to figure out what's out there, download our app. It'll give you some great resources for looking at homes. And probably the best thing to do is just set up a meeting with us, and we can go over whatever it is that your questions are. On this page here, you got our info. There's a phone number that you can text or leave a message at. You got an email. You can call our office. We are located in Danville. You can give us a call and ask for either of us. There's our address down there. Now, does anybody else have any other questions? We do work with VA loans. We have a couple of really great lenders that can help with that. One that I think we have one that I am a big fan of. His name is George Moody, works for RPM Mortgage, and he has a ton of experience with VA loans. VA loans are a really special loan because they help you get into properties that others can't with a zero down payment. And we have some strategies that help you get selected on those loans. Any other loans out there, or any other questions about loans or the process? The question that we have is, what is the average market looking like in the Bay Area? So the Bay Area market is moving pretty quick, especially in the entry level of each city. So depending on what the area is you're looking for, if you're looking for, say, Pittsburgh, Antioch, the price point's going to be lower, but you're going to have a lot of activity on those entry points, and those are going to be roughly right around $300,000 to $450,000. Say you move into the Concord area, you're going to have an entry point of closer to $500,000. You get into Clayton, you're probably looking somewhere around the entry point for a single-family home, because there's not very many condos in Clayton. You're looking at, I'm going to say, right around $625,000, $650,000. Get over to Pleasant Hill, you're going to be looking closer to the 600 mark for an entry-level home. And as you get closer to Walnut Creek, Lafayette, you're going to jump up to, in the entry price point, right around $675 to $750, depending on what it is you're looking for. And as you get closer to, say, Alamo, Danville, it goes up a little bit, not extreme on the entry level, but it does start going up as you get down 680 South. And if you get in towards 24, going towards Lafayette, you're going to look at 800. Get into Orinda, maybe 900. And then you get into the city, San Francisco, you're probably looking for a condo, roughly 800 to get into something like that. A single-family home, you're going to look at $1 million. Oakland, a little bit less. Emeryville, a little bit less, but that's kind of a ballpark. So the question is, in relation to the average market, what kind of income should you have? So if you're at 500, if you're looking at $500,000, $100,000 of income, it's going to get you approved for that loan. If you move up to say 750, it's going to be pretty close to 150, and just kind of going up from there. And it also depends on what kind of a down payment you have. If you have good credit, you're going to qualify for a lower interest rate. So if that interest rate is lower, it's going to give you a better buying power. We have seen interest rates in the last couple of weeks fall, which has been really great. Not a lot, but an average 30-year mortgage is right around 4%, which is a really great rate. As we see those start to climb, a rule of thumb is for every percent that your interest rate goes up, you're going to lose 10% of your buying power. So what you could afford on a 4% loan versus a 5% loan is going to be roughly 10%. Hopefully that makes sense. If not, just let me know and I'll be happy to try to explain it better. For a single, there's another question. For a single person looking to buy a home in the Bay Area, what would be my best advice? Best advice is to meet with a realtor, preferably Devin and I, and we can walk you through the process. But what you want to do, first thing, is to get your finances in order. You want to make sure that what you're looking to get in the area you want, that you can afford it. One of the most devastating things to any home buyer is to fall in love with a house and not have your finances in order, meaning you don't have an approval to write an offer on that home, and then it's kind of depressing. So what you want to do is get in contact with us, and we can set you up with our lender. He or she can get you pre-approved, and then also that will help you define really where you can be looking, because it'll tell you the most that you can afford with your current situation.